why I entered everything I did. So on the daily time frame, you can see here that the overall price is moving to the downside. We have seen high, we have a high, a low. Price came back up, created a high, created a low, created a high, created a low, created a high, created a low. And price came back up here, created a high. And what we're expecting is obviously we got a double bottom here, equal lows. We have some sort of liquidity around here. So again, what we're expecting, either just with market structure alone, we're expecting the favored price movement to the downside, right? So we could long-term target here if price is going to come down to these 1600 handles. So again, we're just overall looking for sales. When we go to the H4, however, we can see here that the overall, not overall, but if we look at this, right, we previously have a valid, sort of demand zone, and if you look at this, as a range, we can see it's a range created demand zone as well. So if we just drag this to the high to low, we can see the equilibrium lines up with this sort of imbalance and order block here. So I was looking for a sell as long as it was within this sort of region, but my preferred region was around this equilibrium of the range. So as you can see, price tapped into that on a smaller time frame, in which we'll go into now. So if we'll stay on a 5 minute. I don't think we need to go any lower. So yeah, now actually what I'll do is I'll go to the 1 minute and I'll explain to you where we could have entered, right? So as we know, it was a higher time frame point of interest, low time frame execution. Okay, so what we're looking at is simply for price to tap into this region before selling off. Now if we just look at this here, we can see here we did have a short-term reaction in which we could have capitalized on and actually targeted around this imbalance somewhere, or this here. And that would have been a nice trade, right? But it was very choppy, and I wasn't trading at this sort of time of day. But that there, you could have took this trade based off, previous markup, range, markdown, right? But as you can see, price came up to here, which we were focusing on at the time of taking this trade. And as you can see, price started to, make these highs and lows. And the reason why you're probably wondering, well, why didn't you take the trade off here if this tapped into the open? And the truth is because it didn't break any structural lows. We had this swing high low here to get taken out, create a new low. So what we're expecting obviously is for price to create another sort of supply zone and hopefully break that structure. But it didn't. It sort of ranged, went back up, closed above here. So at this point we expect the price to continue higher. But until we get the break structure, we can't say anything. As you can see, price came back down, didn't break any structure, so we're still within bullish structure. Broken above, created a new high, low, high, low, high, low, high, low, right? And as you can see, we had no break of structures, okay? Until, if we look over here, we had a break structure here. Now, if we look at the Wyckoff price cycle, we can see here that we need a previous markup in order for there to be a distribution. And within that distribution, we're expecting just pretty much sideways consolidation, and for price to spring or a thrust after distribution to the upside, right? But it's just a spring or a fake out to the upside, and that's my distribution accumulation phase. I keep it very simple. I don't look to, like I say here, we don't need to mark up every price point. So as you can see, I didn't start marking this up. I didn't, see this as a buying climax. You got thrust or thrust after distribution, a test. I didn't need to mark all that up, even though we could have. But I was just looking at the simplicity of it, and I like to look at this when copying Wyckoff phase. So as you can see, price started accumulating just orders. It's just ranging to the side, gathering up those sell orders in order for the big push to the downside, which we've seen later on. But as you can see, we had a break of structure, so this was now our valid sort of supply zone because we are within this range. Now, as you can see, we had an order block up here, right? The reason why I didn't take this order block trade, look to mitigate there, is simply because on the 5 minute time frame there was no order block there. The order block started here and ended there, so we drew that on and we just refined it to the most extreme price point, right? And this is the most noticeable blue candle, so I refined it to that. And the reason why I put it to the high simply because my obviously stops in order to be in this trade would be above the highs, right? So about there, okay. As you can see, the price came back into this region, tapped into it very nicely, and was in the trade. Now, if you were more of an aggressive trader, you probably moved your stops to break even and took partials, and that's okay. But if you're more of a calm, collected guy, you can, your risk tolerance is good. We know that in order to move our stops and stuff like that, we need to wait for this break below this swing point. The reason for that is because, again, we're still within this range. So price can do what it wants. It can come back to entry if it wants to. Again, it can come back to entry again if it wants to. But until we see a break of that low, then yeah, that's when we'll obviously look to move our stops and stuff like that. Okay. So just consider that, take that into account, and just remember that understand your ranges, because this is now our range. Even though we're making these complex pullbacks and minor structure breaks with substructure, we're not interested in that, because we're overall looking for sales, and this is why it's so important to stay disciplined and not get sidetracked. So as you can see, price tapped back into the open. So if you did take a trade off the open, you would have got a nice around 25 to 30%. We took a trade off the equilibrium, right? So this body open here, for example, you would have got a nice trade, of at least 40 to 50%, right? Even 60%. So price came back up to break even. We're still sort of in this trade at this point, and then price came back up again. Definitely came back to break even, unless you caught the top somehow. But as you can see, price came back up to break even. But our stops are protected anyways because it's above this high. And then price started to melt away. And as we started to leave this range, that's when we start to move our stops to break even. And if you go back to the 5-minute time frame, you can see here that we targeted down to this demand zone. So if I just mark this up, right, we targeted this demand zone here, right, on the open of it, and as you can see, that would have been a nice 51.5% trade. And yeah, that was pretty much it. All we did was we noticed the range and the liquidity sweep, right? Because that's all the price cycle is. We don't need to be all fancy and mark it up, because people do that, don't get me wrong, but it's unnecessary. They don't need to mark it up, they just do it because, well, it looks cool, right? It attracts new people when they come to trading, because they think the more complicated your charts look, the better trader you are, and that's not true. You'll only usually see me with a couple of zones drew on my chart, and that's the simplicity behind it. We've got to keep it, because everything else is just noise, right? Because when you train your eyes to see something, you can see it, right? We don't need to mark up every single phase or point that we see. The only thing that I mark up every single point is the structure, because that is very important. And yeah, if you don't mark up market structure, you can read it wrong easily, because you get focused and distracted on the small time frames. So that's the only thing I mark up. But it was a very simple trade. And then what happened from here is, if I just I'll just go to the H4 time frame, just let price play out. What happened here is, if we were to target down to these lows in the H4 time frame, then that's fine, but we would have been stopped at break even. However, if we just go back to the 1-minute time frame, or the 5-minute wasn't it we was on. So if you just go to the 5-minute time frame, right, you can see here the price came back to sort of our area. And it did come back to break even. So if you didn't move your stops, you still would have been in that trade, and that would have been a perfect trade. But if you did move your stops and you have your stops above here or whatever, then that's fine. But when we like I said, we trade imbalances and order blocks, we know that price could still tap into this imbalance. So for that reason, I personally wouldn't move my stops. I would have probably moved my stops to around here, just a bit in profit above the equilibrium, and then if price was to come back, we could look at that as a scaling opportunity, and again take a nice trade from there, and just target this demand zone, target down to these lows down here. Or if we were a bit ballsy, and again we could have our stop loss above, just above the equilibrium, simply because that's where we have our other stops, alright. But if we were to go back to the H4 time frame, or let's just go to the H1, 15-minute would be better. Right, if we were to target these H4 lows, where were they now? H4 lows, which would be down. Would it be down there? No, it wouldn't be down here. It'd be down here. Right, if we were looking to target these H4 lows, so this imbalance, let's say, to there. If we go back to the 15-minute time frame, you can see pretty nicely. Alright, so we could have refined that maybe to this one, just to be realistic, because obviously these are all been tapped into. So yeah, about there would have been perfect. And this is me being realistic. Most people would just be like, yeah, we could target down that, because obviously we're going to get a bigger reward targeting down here, right? Or you could even just refine it down to these lows, which makes sense actually, because obviously that's the most extreme swing point. So I am going to be one of those traders and target the most extreme. But as you can see, from this trade alone, that was 224%. And that was 44.86%. And all we did was, again, higher time frame point of interest. This has been more of a trade recap. It was a higher time frame point of interest, but we started to see those liquidity sweeps, and we didn't see it on the on the second trade, but we've seen it on the first trade, right? So if you didn't want to scale in, if you only traded Wyckoff, then the second trade might not have been for you. We can take a look, but we can't see much of a range, and we can't see much of a liquidity sweep, right? But if you go over here, we can. So that again, this would have been the better entry, right, around here. But again, if you didn't include break structures, you could have took a trade off this order block here and looked to sell from there. But obviously we have to include breaker structures because there's going to be sometimes we're going to get stopped out and stuff like that because we didn't include it. So if we do include it, then obviously it's going to be more of the high probability setups, and that's all you need to understand is order blocks, breaker structures, and ranges. That's all you need to understand. Obviously time zone as well. So at the time of taking this trade, it was, you know, in the learning session, we didn't see much of you know, we've seen this sort of move to the upside at the, you know, learning breakout, then price started ranging. So obviously as we were flipping into that New York session 212, was expecting that, you know, sort of sell to the downside, right? But yeah, just understand your ranges, order block mitigations, and you're pretty much good to go. But yeah, it's been quite of a weird video. I don't know what you think of this one. Let me know. But it's more of just like, you know, if we just ignore the other trade and just focus on this 224% trade, that would have actually been a perfect setup, because we wouldn't have moved our stops to break even until we had broken this low, if we understand our ranges. And that's been the more of a calm composite man, right? But if we're more of a aggressive composite man, that this a fictional character who plays aggressively in this game, then we probably would have moved our stops and been taken out of break even. So it's up to you what you would have done in this case. It's completely up to you. It's alright for me to say, oh, I wouldn't have done that, I would have, you know, but it's the truth, right? So it's up to you. If you want to be more calm, you will probably find yourself with nicer trades. If you want to be more aggressive, you'll find yourself that you're going to be stopped out quite a lot. But it's okay, because if you're more aggressive, then you are going to be taking those more trades. So it's going to balance out nicely if you're a calm guy as well, I suppose, right? And when I say calm guy, it just means like, you know, you take confirmation entries all the time. You believe in the theory that less is more, and it's true, and stuff like that. So yeah, I prefer to be calm. Sometimes I do get quite aggressive on the charts. I look for those 1 minute scalps, but you know, this is simply a high time frame point of interest, low time frame entry. You know, and just including Wyckoff. And like I said, when it comes to the distribution, you don't need to mark it up. All right, I'll pull up some examples. Sorry. So this is obviously our resistance and support, right? But as you can see, if we just take a look at this, we can see here we have a high. We see a bit better on there. Let's go to the 5 minute. So obviously we got the buying climax, up thrust, UTAD, right? Up thrust, UTAD, and a test. And this here test is our test. Okay. So you could have mitigated an order block on a small time from here. Or again, when price starts to create these last point in supplies, which is here and here, these are the last points in supply. So this is why I focus on the most extreme in order blocks and stuff like that, because it's the last point. But as you can see, last point in supply in which there is any supply left, because there's no supply left above here, because it's already been tapped into. And this is what mitigations is, right? When there's supply left, there's going to be order blocks that are unmitigated. But when there's no supply left, that means all the order blocks have been mitigated, and that's what we mean when we say mitigations and stuff like that, right? So as you can see, last point in supplies, then obviously we start breaking to the downside, and then from then we're seeing a sign of weakness and a break to the downside. And as we enter into phase E, you know, phase E is pretty much anything onwards from here. So again, if you want to take the scaling trade, you can, because it's still classed as the Wyckoff distribution, because we're in phase E, and phase E can go on for however long. But phase E would be, you know, where price randomly comes back into it and taps into, you know, a supply zone. And you'll see this a lot. So it's up to you how you take it. Yeah, but just that's all I did was I noticed at the 3 points, and it's the exact same when we look at an accumulation phase. I'll show you now. If we look at schematic number 1 in accumulation, I look for the 3 lows, so the SC, ST, and spring. I don't focus on these highs, because again, you know, if you look at these, anything can happen on the highs and, you know, the lows in the distribution case, because sometimes you may see the automatic reaction be lower than the sign of weakness. So I only focus on the 3 points, and sometimes if you only get 2 points, then that one might be a distribution schematic number 2. So if we were to factor this in, we've seen this as a preliminary supply, we can factor these 2 points in, and this would be, you know, that. But just focus on the 3 points, or the 2 points, sorry, here, right? But I'll go on accumulation in a separate video. But that's pretty much distribution schematic number 1, and that was a nice perfect example. It may be complicated, but again, just don't mark it up and focus on the 3 points in price, and that's my best tip to you. You can go ahead and mark it up, because sometimes you will see it literally spot on. If you go in the Discord as well, there's plenty of examples in the chat of me marking up every point. But you know, when I'm looking for an entry off a high time frame point of interest, I do like to see 1, 2 liquidity sweep, test, boom, right? So maybe I'll come up with some sort of rule for it, because as we've seen earlier in the course as well, you know, you got the where price is ranging, the initiation, the mitigation, and so on and so forth. So maybe we could look at renaming it, you know, and personalizing it. So for example, 1, 2, 3 test boom, right? And that's simply what it is, but obviously something cooler to that, so you know, so whatever, right? But yeah, I'll stop going on now, but that's pretty much it. It's very simple. You don't need to go ahead and monitor the phases, just look for the 3 points, right? And then on the third point you should see a break of structure, and this is classed when I say point, I mean, like, you know, if we look at the UTAD and test, that's still phase C. So what you're seeing within here and here is your phase C, right? So A, B, I can't draw that, B, C, D, and then obviously anything after, as we, you know, leave the sort of lows, is phase E onwards, right? So A, B, C, D, and E. So yeah, that's pretty much it. And like I said, there isn't really much to it. It's nothing crazy. It's just 1 touch, 2 touch, liquid desweep, test, boom. Okay, you can either enter off the test, you can either enter off later on the last point supply, or you can either enter in phase E, which is the most high probability, because we know that price is broken to the downside, so it's most likely going to continue to the downside. Okay, but again, if you took that one alone, that's 224%, and that there, guys, is literally Wyckoff distribution. The more you practice it, the more permanent it will become on the eyes. So make sure you do practice that one a lot and just start to draw up the highs, right?